Hello, everyone. Thank you for coming. I hope you enjoy the spring weather and talk about tax. Okay, we're going to continue on with our discussion here. I just want to reiterate the important thing about permanent, temporary, unfavorable, and favorable. Each item we're talking about is permanent or temporary, favorable or unfavorable. And noting that it's timing, favorable and unfavorable, we're going to flip based on where you are in that timing. Right? Something might start off favorable, but there's a timing difference. We always equal at the same at the end, so then it turns at a certain point. The parlance people use is it reverses. That just means that it switches from being favorable to being unfavorable or vice versa. Okay? All right. I think we are my first example, so we're going to start right off the bat. So, Hollis, are you ready to do 5-1? Hollis here? Okay. Right off the bat. Oh. All right, go ahead. We're on slide 10.
Elise reviewed PCC's prior year tax statement and its current year trial balance. She discovered that PCC earned $12,000 of interest income from the City of San Diego municipal bonds, expensed $34,000 for premiums on key life insurance policies, and expensed $28,000 for business-related meals. What amount of permanent book tax differences does PCC report from these transactions? Are these differences favorable or unfavorable? And then the answer is that the interest income from the City of San Diego municipal bonds is favorable, and the premiums paid for key life insurance policies and meals expense are unfavorable. And that comes from the exhibit 5.2, which is in the slide below, that kind of details the common book tax differences.
Yeah, so sorry about this slide. It's definitely not like that on my screen. Hopefully it was working through shortly. So let me get caught up with you. So the interest on the income from the City of San Diego municipal bonds. So municipal bond interest is not taxable, but what happens for book purposes? Nothing that excludes interest income, right? So it's in book income. We have to get to taxable income. So it is favorable because we get to reduce it because we're not paying tax on it. So it's a negative. And the negative here is reducing book income and arriving at taxable income. Premiums paid for key life insurance policies. We haven't talked about that in detail, but they are not deductible for tax purposes. Right? There's no such rule for accounting purposes. So it's deductible for accounting purposes. We have to add that back in arriving at taxable income, so it becomes an increase of the unfavorable guide to us. And then meals expense, we did talk about. That's the 50% that is tax deductible. 100% is deductible for tax or for book purposes. We have to add back that 50% driving the tax line. Okay. And these are all permanent items because there's no timing. When you look at the two rules, it's never going to equal. Right? So permanent items, the whole distinction here is favorable versus unfavorable. Okay. Rolling along 5-2, August.
Well, if assume that PCC audited financial reporting income statement indicates that federal income tax provision is $2 million, what is PCC book tax difference per year associated with these expenses? The difference is favorable or unfavorable? Is it permanent or temporary? Because it was deducted in the book income and cannot be deductible for tax purposes, so like $2 million must be added back, and that was unfavorable. Permanent book tax differences because it's not allowed to deduct the federal income tax expense for tax.
Yeah, so this is right. Book income is a net income number, so tax expense is going to be in there, so it's going to deduct the federal tax expense. We do not deduct federal tax expense in arriving at federal tax liability. It's not a circular calculation. So we have to add that back in arriving at what is federal tax line. Okay. I'm going to try turning off my laptop for a moment, so bear with me here. If we don't do this. waxed hour. Sorry about that, it's just not connecting. So I'm on slide 11. Power through this as best we can. So that was permanent items, right? It could be income expense items, it could be favorable, unfavorable, but they never reconcile over time. Contrast that with temporary differences. Okay, temporary differences will equal over time, okay? And so the chart on slide 11 just is common book tax differences that are temporary in nature. You can think of this as, you can probably find online a list, a comprehensive list that here's things where there's differences that are temporary in nature between book and tax. But these are some of the more common ones, and they may be applicable to your company or your client, and others may be for others. So the first one is depreciation expense. That's probably the most universal because, again, depreciation expense for accounting is much different than the prescriptive depreciation expense rules that we went through a couple weeks ago. Accounting's going to set it up on their own estimated useful lives and take depreciation on a straight line basis. Tax is totally different, right? You're either in makers, but you got to find the right table, a certain percentage, but it is accelerated, or it's bonus depreciation, or it's Section 179 immediate expensing. That's the accelerating depreciation. So we're going to have timing differences, temporary differences, or timing differences, but what they're ultimately going to equal over time, right? Because our basis is our basis. You buy an asset for $1 million, you're going to depreciate $1 million for financial statement purposes and tax purposes, just over different periods of time. Okay, and they will flip. This right-hand column over here is the initial difference. Okay, the initial difference being that it is favorable. Okay, why is it favorable? Think about what book is doing. Book is that first year, taking 1 over something, whatever the useful life is. That's the straight line for that first year. We might put all of it in the first year for tax purposes. So we are increasing the deduction for depreciation expense that we find on the financial statement in arriving at taxable income. So it's a favorable initial difference. Midways through this chart is bad debt expense. So remember the differences there. Accounting is estimating the amount of bad debt expense every accounting period. And that's usually as a percentage of the accounts receivable balance. But for tax purposes, we don't get to estimate that expense. Remember back when we were talking about bad debt expense, we have the all events test. The all events test requires economic performance. The thing must have become uncollectible, the account. So remember we had an example where Jacob refused to pay, we couldn't make Jacob pay. That is the bad debt expense, not some estimate based on the balance of accounts receivable. So that is unfavorable, okay? And these are temporary in nature because what is estimated for accounting purposes over time might be deductible for tax purposes as those estimates come to fruition, right? If you estimate 2% of the balance is not collectible, ultimately over time we might see those accounts roll through as being truly non-collectible on an account-by-account basis. Deferred compensation, we're going to talk about that in detail in a moment. Deductible when accrued for book purposes, but deductible when paid for tax purposes. If accrued but not paid within 2.5 months of year end. So that's an unfavorable amount because it's going to be deductible, because on an accrual basis sooner than what we get for tax purposes, right? When paid for tax purposes. So we're going to have a timing difference there, but the amount's going to be the same over time, for tax years. Okay, and think of that right-hand chart as the initial difference, and when the timing differences start to reverse, that's when the designation as being favorable, unfavorable will flip as they're starting to catch up with each other. Okay. Okay, the next page on that chart, Unicap. Unicap, when we talked about inventory, remember Unicap was capturing some non-directly associated expenses within the organization and capitalizing them into inventory. Accounting is only taking the production costs into inventory. So we're capturing more expenses for tax purposes, putting them into inventory. They don't become a deduction until the inventory is turned. It becomes cost of goods sold, right? So we have a timing difference because accounting is going to be ahead of tax. And usually not more than a year, right, because the inventory is turning. But we're going to have a lag of tax versus accounting. That is going to be a timing difference, and that is going to be unfavorable because this is driving up taxable income because we're deferring the deduction relative to it. Okay. Interest expense. The deduction for interest expense can be limited. We're going to talk about this in detail for tax purposes. You don't have a limitation on interest expense for accounting purposes. So whatever you incur and accrue in the accounting period is going to be deductible for accounting purposes, but we have a separate test that we're going to go through for how much of your interest expense is deductible in that year for tax purposes. And that would be an unfavorable item because accounting is, if we have a limitation, accounting is always going to have more than tax. Now, I may not be limited for tax, which means I don't have a difference. But if I do have a difference, it will be unfavorable because accounting will be higher than tax. Okay? Installment sale. Remember what happens in an installment sale? We covered that in tax deferred transaction. I am recognizing the gain that is realized over time as the proceeds come in on the note. Right? I'm selling something, the buyer agrees to pay for the property over greater than 1 year. As those payments come in, I start recognizing the taxable income. What's accounting do? There's no such thing as installment notes in accounting. You sell something for a note, that entire gain lands on the financial statements. Right? So I am going to have a favorable temporary difference because I'm stretching out the recognition of taxable income relative to accounting. So accounting is going to have it all in year one. I'm going to pull some of that out in year one. And so that's a favorable initial difference. I'm lowering book income and arriving at taxable income. I always like to think of this. This is like mental gymnastics. You just got to get your mind into this this area, and it's good because you're covering accounting and tax. Like-kind exchange, similar. We talked about that in tax-deferred transactions. That's when I take real estate of a like kind and I exchange it for similar real estate of a like kind, and I have a deferral transaction. Well, what happens if I take one piece of real estate and I exchange it for another piece of real estate for accounting purposes? I disposed of the original real estate. That transaction is recognized. Not recognized for tax purposes. If we meet the like-kind exchange rules, remember we have the timing requirements, has to be the right type of real estate relative to our business, but I defer that into the future. It's a timing difference because it's not forgiven tax, it's just deferred. Okay? And it's favorable because it's in book income and I'm pulling it out of book income on my way to going to tax income. Yes, Arthur.
So temporary tax differences, could we see them as tax interest-free loans from the government? Especially if it's a deferred tax asset.
If they're favorable, you can look at them as the government choosing to postpone your tax on that, right? If it's unfavorable, then it's the opposite, right? The government has chose to write a rule for tax purposes that is more onerous than accounting. So it can go either way. I want to say it goes either way. Yeah, so I wouldn't necessarily call it an interest-free loan, it's just more the deferral of recognition, if it's favorable. If it's unfavorable, they're not deferring it. Okay. All right, we're gonna have to get the power on here, I apologize for the technology. 5.3 is Lauren. You wanna do this one for us? Hopefully you guys can follow along on 5.3, obviously.
And capitalized in return for and 2025. And are these book tax differences? So for 2024, the book tax difference is $96,667 unfavorable compared to this. And that's because for books, the entire $100,000
Yeah, so for accounting purposes, they're just completely expensing that amount, right? That makes sense. This is not an asset that they capitalize and amortize over time. But if you go back and look at what we did for organizational expenditures, if it goes above a certain amount, then we have to capitalize it and amortize it over 180 months, right? And we only have 6 months in this tax period, tax year. And so we get a very small amount for tax purposes. And I think what you do in this area, because this is a fruitful area for someone asking you questions about on a midterm, is isolate what happens for accounting purposes, and then isolate what happens for tax purposes. And then I like to think about, I'm going from column A, which is the financial statements, to column C, my tax return. What is it doing? Is it increasing my taxable income relative to book, or decreasing it? And that makes it favorable, unfavorable. And I got to think about whether it's permanent or temporary. Okay. All right. Keep going.
For 2025, the book tax difference is $6,667 favorable. And that is because the entire amount of organizational expenditures is expensed in 2024, and so there's no organizational expenditures remaining to tax for book taxes. However, for tax purposes, you can deduct 12 months of
So I'm going to keep hitting that 6667 favorable temporary difference every year, right? Because it's going to just keep rolling through for tax purposes. And I'm already done for book. Book was done with it a long time ago. And so this is where you can imagine when I talked about the two parts of the organization talking to each other. Book is done with this. You start asking them a question about organizational expenditures, they'll be like, well, that happened 2 years ago. I don't care about that. And this year, well, tax, I'm still going. Still going until I fully recover that. Okay. Okay, thank you. Okay, so this taxes in the real world article. A couple things, I got 2 of these articles in here that I want to kind of highlight on, but are focused on. And so there's a couple things going on here. So the premise of this article is 55 corporations back in when they looked at this paid 0 taxes in 2020 despite reporting significant pre-tax profit for book purposes. Okay, so the tax return showed 0 tax liability, but when you go out and you look at the publicly traded financial statements, big income. So for the non-tax person, what's the disconnect, right? And you think of the non-tax politician. Oh, that's weird. I see these giant income numbers on the financial statements, but you're not paying any tax. What's going on? So, for instance here, they talk about Archer Daniels Midland, which is a large ag company. I think they're based in Chicago now. FedEx, Nike, Dish Network, and Salesforce. The report indicates that tax breaks. I highlighted that because be careful of the language that politicians use, non-tax practitioners use, general public, reporters use, people who write articles use. That does not mean that that's inappropriate, right? I think a tax break is the law. If you write the law, that doesn't make it it's not a break, it's just what the law says, right? So tax breaks such as deducting the bargain element of non-qualified stock options, which we're going to talk about in a moment, or accelerated depreciation on business asset purchases, i.e. that 100% bonus depreciation, or the research and experimentation credit, or R&D, are the reasons some corporations are not paying taxes even though they report profits for financial statement purposes. That's the law. That's what Congress wrote. Don't beat a corporation over the head because they claim bonus depreciation when that's the law that you wrote. I mean, you see, it's funny. They put them into conference tables in front of Congress, and these subcommittees will beat them over the head with these rules. Like, why are you doing this? They're like, I don't know, but I hire a bunch of tax people, and this is my tax liability. You know, it's not inappropriate for me to claim the deduction that I'm entitled to. So I just want you to kind of be aware of that, whether you go into tax or not. You know, it's an easy target, but then I think it's for the uninformed to be slinging the arrows. So there may be legitimate reasons why a corporation may pay zero taxes despite reporting profits for book purposes. Book and taxable income serve different purposes. Right? Financial statements are doing one thing, tax is doing another. They don't look to each other and write their rules. Right? Congress doesn't look at what happens for accounting when they write tax rules. They do what they want to do on the tax rules. The article concludes that it's a mistake to determine that something is amiss when a corporation has a $0 tax bill because Congress makes the tax laws that corporations are following, and Congress could change the tax rules to conform more closely to the book. Power of the pen. If you don't like that, get the votes and change the law. You can do straight line depreciation if you want, right? But there's a whole bunch of people that don't want straight line depreciation when they're writing the tax rules. Okay. Congress recently changed the tax rules to impose an alternative minimum tax, an AMT, on certain extremely large corporations with high book income but lower taxable income. So this is, if you had individuals, we talked about AMT in the individual front, and I preached a little bit about how unfortunate it is to set up a parallel regime instead of, if you don't like the result, go in and change the substantive law instead of making us do a separate calculation. But we've always had, or we've had this for decades on the individual front, and the Biden administration, they started it on the corporate front. Now, the good thing is it only applies to the very, very biggest. So the thresholds that this applies to is for, think of the big behemoth companies that are out there. And what it does is it starts with book income and makes adjustments, very slight adjustments to it, and then applies a lower rate than the 21 that we've been talking about. Parallel regime. Instead of going in and changing the depreciation, and if you don't like the stock option result, and you don't like R&E, instead of changing the substantive rule, you're starting with book income in a separate computation and then taxing it at a lower rate. You got to pay the minimum of this year. So that's what it is. But I feel that's very unfortunate. That to me, you hear me preach about complexity is good. It's good for jobs, good for job security. But this is like unnecessary in my opinion. It sounds good. You can say, I'm making corporations pay the minimum level of tax. Well, you could have done that anyway by changing the law. Okay. Okay, so now we're going to go through some, on slide 14, we're going to tumble down through common book tax differences and just get granular. Again, set up what happens for book, set up what happens for tax. Let's talk about what the difference is, permanent versus temporary, and whether it's favorable or unfavorable. So the first area we're going to cover is dividend income. Corporations receiving dividends from another corporation in which they own stock may account for the dividend income in different ways for book and tax purposes. Book treatment of dividend income depends upon the receiving corporation's level of stock ownership or control in the dividend-paying corporation, right? Whether you count the dividend income or are you picking up components of the dividend-paying company's total income statement, right? And so that's going to go into the level of control. So it's not going to be a hard and fast certain percentage ownership. It's not just that, but it's also board control, that type of thing that's going to go on there. For tax treatment, corporations include dividend income and gross income, right? Gross income is very broadly written. We have three scenarios that I want to go through on dividend income. So let's say the first scenario, the dividend recipient corporation owns less than 20% of the stock of the dividend paying corporation. So minority ownership. Okay. Book and tax treatment, dividend income is included in income, likely no book tax difference. If you own less than 20%, I'm pretty optimistic the accounting, unless there's some kind of quirky control aspect to that 20% ownership, I'm optimistic that accounting is not going to treat that as an equity investment. And so you're just going to have dividend income. What can happen for tax? We always have dividend income. So I think you're going to have book tax in that scenario. Scenario two, let's say we ratchet up the degree of ownership to at least 20, but less than 50. Okay? Book treatment, the corporate owner usually includes a pro rata share of the dividend-paying corporation's earnings in its book income under the equity method of accounting. That's going to be a different number than the dividend income, right? Because dividend income is the amount that the after-tax earnings that the company then chooses to distribute. That may be different than the earnings because they may reinvest some of their earnings. The equity method of accounting is going to pick up your share of the earnings. What happens for tax? Dividend income is included in gross income. A book tax difference can arise if there is a difference between the earnings under the equity method of accounting and the amount of the dividend received. Right? So if the company made 100 but only paid a dividend of 80, I'm going to have a book tax difference because your pro rata share of the 100 is going to be different than the amount of the dividend. And that could be flipped as well, right? Because a company can distribute more than their pro rata share of earnings because what if in the prior years they built up earnings that they didn't distribute? They might pay out more this year than they earned this year. You can have go either way, favorable or unfavorable. Okay, so our third scenario, let's say the dividend recipient corporation owns more than 50% of the dividend paying corporation. Book treatment, the corporate owner would likely consolidate for financial statement purposes with any dividend income being eliminated. If you own greater than 50%, the presumption, I believe, it's been a while since I've been in an accounting class, but the presumption is that you control the entity. And if that element of control is in there, then you're consolidating the results of the subsidiary with the parent. Dividend income is excluded at that point because you're picking up all the results of that. They'd be combined in the financial consolidation process. Tax treatment, dividend income is included in gross income, except in cases where ownership equals greater than 80, at which point tax consolidation is typically elected and then the dividend income is eliminated. Now this is presumed here that the two corporations, the recipient and the payor, are U.S. corporations. So we have a concept of a consolidated tax return in the United States. So if large multinationals have a lot of U.S. subsidiaries, if they own greater than 80% of those, they're likely electing to file a consolidated tax return, which means they file one tax return, reporting all the results of everything. So by definition of doing that, you're doing just what accounting is doing. You're eliminating any actual dividends paid between the entities. You can't double count here. Okay. So let's go through a couple examples. 5.4 is yes.
The PCC Just discuss the other 20%, we are trying equity method for under the equity method, PCC doesn't recognize the instead it recognizes the shares of each net income. So BCS reported the 100K the net income and PCC 30%, so
Yeah, so just pause there. So the subsidiary makes 100,000. We think we're in the equity method of accounting. This is when we're walking down the hall. We're talking to our accounting friends in the corporation, saying, "What are you guys doing for book purposes?" And they would say, "Hey, we're doing equity method of accounting here. We're going to pick up 30,000." of this, because we own 30% and they made 100, right? And then, right,
Yeah. However, for the tax purposes, we don't use
it doesn't exist for tax.
the taxable income includes the actual dividend received, which is 40K. The taxable income is 40K and the income is 40K, and the difference is 10K.
And it's
That's unfavorable.
And it's unfavorable, why? Because I'm paying more tax, right? The favorability is it costs me money of tax or does it reduce money of tax? And so, you might say, again, why would something that makes 30,000 be able to distribute 40,000? Well, in prior years, they may have held on to more cash. So this year, they just had more available cash that they could distribute than this year's earnings. And so that's why it's an unfavorable $10,000.
Move on to the second case. PCC owns only 2%, that's the below 20%, so we don't apply the case with it. For good purposes, dividend received as income, which is 40K. On tax purposes, it also includes the same 40K dividend for income. So we can tax the same, but there's no good tax.
Yeah, just because of the low amount of ownership between the two. And again, this is where the interaction of the two. You might be asking, well, we're gonna do something with the dividend, and the accounting person might say, well, why are you asking that? It's irrelevant. We're on the equity method accounting in the first part of this example. That's where the two sides have to agree. Is you're trying to apply the tax rules, they're trying to apply the accounting rules. The interaction of the two is this book tax difference, and when we get to chapter 9, I believe, when we do tax accounting, that's when we're doing journal entries to reflect all of this stuff. All right, we're rolling now. Okay, so dividend income is in gross income. We know that for tax purposes, right? Because gross income is everything, unless Congress tells us otherwise. They are not telling us dividend income is not in gross income. So corporate shareholders, that's the most important here. I'm not kidding you. Okay. Take over here. Corporate shareholders as opposed to individuals. So if I have a corporate shareholder, I am allowed a dividends received deduction to mitigate the incidence of double taxation of corporate earnings. Okay, remember, double taxation of corporate earnings, right? Tax at the corporate level, because separate corporation pays tax at 21. When after-tax earnings are distributed, I have a second layer of tax. That's the double taxation as a function of the corporate tax system. DRD percentage that is allowed is trying to take into account that I might have tiers of corporations. And if I have double taxation all the way up the chain, by the time I get the money out of the corporate solution, it's been chipped away at so much that doesn't seem appropriate. Now, you could say, I'm going to give 100% dividends received deduction, but the government doesn't say in all instances it's 100%. So they alleviate it, but don't eliminate it. That's the way to think about the corporate DRD. An individual, if somebody ever asks you, an individual, there is no DRD in the individual world. It's pure double taxation. Corporate level, individual graduated tax rates, maybe it's qualified dividend, individuals. But corporate shareholders, so the amount of the DRD depends on the level of corporate ownership in the dividend paying corporation. It's multiplied by the DRD percentage, and that constitutes the amount of the dividends received deduction. So 100% of the dividend goes into gross income, but I get a deduction for a certain percentage. So it's the net effect would hit back the bottom line, taxable income. Okay? So if I am less than 20%, I have a 50% dividends received deduction. If I'm at least 20%, but greater than 80%, it goes up to 65. If I'm greater than 80%, I do get a full elimination, the 100% dividends received deduction. So I just have to hone in on the facts. How much do I own? And then have this in my notes or have this committed to memory. Okay. Just what is the exact dividends received deduction? And this is only for US to US. Those of you that are in my international course, if I have a foreign subsidiary paying a dividend in the United States, do not apply this chart. This is US Corp to US Corp. Okay. Book treatment. Dividend income is included in in the income if the recipient corporation, unless the previously discussed equity method of accounting or financial consolidation applies. Right? They don't have a dividends received deduction. It's just, is it dividend income? Is it equity method of accounting, or is it full consolidation? Right? Tax treatment, a deduction is allowed based on the level of ownership, as we just talked about. Because the DRD is only a deduction recognized for tax purposes, it does not exist in the accounting world. Qualification for a DRD can create a favorable, permanent book tax difference. Why is it favorable? Because I'm reducing book income and arriving at tax world. I'm creating a deduction that does not exist in the accounting world. You walk down the hall and talk to them, hey, what DRD are you taking? Accounting class you took, but we don't take DRDs. So it's only a function of tax, so it's favorable, it's the deduction, and it's permanent because they'll never reconcile. There is no such rule in accounting. Okay? So 515 is applying those concepts. That is Simran. Not here. Anybody want 515?
So this example states that PCC received $30,000 in dividend from Apple Incorporated. PCC owns less than 1% of Apple Incorporated stock. What is PCC's DRD associated with the dividend? Interest $15,000. This since they own less than 20% of Apple, they fall into the first tier, which I we showed in the last slide, which means they get a 50% deduction on the 30%.
So right, that's alleviating some of the double taxation. Because Apple paid tax on their earnings and they distributed after-tax earnings. So it's trying to lessen the burden of double taxation, but it doesn't eliminate it because there's 15,000 of it's taxable at this level. Okay.
And then, like we said, like Professor said, you get that $15,000 and dividend receipt deduction, which means your dividend subject to taxation after DRD is $15,000, and then the U.S. corporate tax rate is 21%. So after you do your corporate tax rate, you get tax payable on dividend of $3,150, and that's when your marginal tax rate of dividend is.
Yes. So, and this is not the full burden of tax because they're not layering in Apple's tax on the earnings already, but Apple already paid 21% on the earnings that gave rise to the ability to pay this dividend in the first place. This is just saying, I got a $30,000 dividend, 15 of that stays taxable at 21. That gives me 3,150. I divide 3,150 over my income of 30. That's the 10.5%. Okay. I didn't quite pay 21, but I still paid something. Okay. Okay. So that's dividend income. Okay. Let's talk about acquired goodwill. So this is goodwill that you did not create in your business. You bought it. You purchased a business. How can you purchase a business? Two ways you can purchase a business. You can acquire their stock or you can acquire their assets. No other way to acquire a business. Okay? So first we're going to talk about you bought the stock of another company. Okay? When the stock of a corporation is acquired by another corporation, the underlying assets of the acquired corporation are stepped up to fair market value for financial statement purposes, right? Purchase accounting. You need to put those assets on your balance sheet. One balance sheet going forward. You need to put those assets on there, not at the historical value that the target corporation was carrying them at. You step them up to fair market value. But the tax treatment of those assets does not change. When you buy the stock of a company, your basis of what you bought is in the stock of the company you bought, not in the assets of the corporation that you bought. Okay, so if they were in year 5 of Maker's 5-year property on that table 1, then you're in year 5 of table 1. You just step into the shoes of what they were doing for tax purposes. Because you didn't buy the asset, you bought the stock of the company that owns the assets. So right off the bat, your ears perk up, book tax difference. Right? If you go through a deal, an M&A deal, and you're advising the acquiring company and they purchase stock of another, you know you're going to have book tax differences all over the place. Because accounting is going to step everything up and start their future depreciation based on those new stepped up values on straight line basis. Tax is going to keep on doing what Target Corporation was already doing. So they're going to have book tax differences all over the place. Here we're talking about goodwill, acquired goodwill, right? Goodwill, both from accounting and tax, is a residual computation. You take what you paid, you start hitting identifiable assets, you start with tangible assets, and then you go to intangible assets, but then you typically result in some excess. That excess is usually assigned to goodwill. Like, sum of the parts is worth more than the parts, kind of concept, right? And so you're doing that for accounting purposes, and you're assigning the excess to goodwill. Okay? You didn't do any of that for tax purposes because we bought stock, right? You just take what they were doing and you keep doing it for their assets. So financial accounting rules, as you know, for goodwill is not amortizable. It's tested for impairment at those balance sheet dates. So is the value of the business the same or higher than when you bought it? If it decreases in value, then you have an impairment of goodwill, right? You have to take goodwill off the balance sheet, which you go, your debit's going to be the income statement, right? And no one's going to do that. Whoever was championing that M&A deal is not going to be doing. But that doesn't happen for tax purposes. We don't even have goodwill on the financial statements because we're carrying on the basis of the assets and the depreciation methods that they're already doing. So a book tax difference does not arise until that goodwill is written off or as impaired for financial statement purposes. Once they do that, we have a book tax difference on the goodwill because that's a deduction for tax purposes, or for accounting purposes when they impair it. But we don't even have the goodwill for tax purposes, book tax difference. Okay? And that's going to be a permanent item because it's never going to reconcile. So the first thing you have to ask yourself when you have a series of facts given to you in an exam or in the real world when somebody's talking about an M&A deal, am I buying stock or am I buying assets? Right? Because the rules are vastly different. In an asset acquisition, the assets of the corporation are acquired by another corporation in a taxable event. And I'm going in and I'm saying, I'm going to buy, think of it as buying a division. I'm going to buy this division out of an existing corporation, but I'm going to buy all the assets and liabilities of that company are going to come into my business. I'm going to put those on my balance sheet. So the underlying assets are stepped up to fair market value, and any residual, again, goes to goodwill. So your accounting treatment, they're going to be kind of indifferent to whether you're buying stock or assets, right? They're going to put those assets on one balance sheet. They're going to step them up to fair market value. Any excess goes to goodwill. I don't do that for stock for tax purposes, but I do it when I buy assets, right? Just like when we talked about depreciation, when I buy an asset, I start doing my depreciation on it. If I buy a collection of assets, I step up my purchase price through those assets with any residual going to goodwill. Remember what we do with goodwill for tax purposes, acquired goodwill and purchase of collection of assets. I amortize goodwill straight line over 15 years for tax purposes. So although I may have a starting point the same of goodwill because I'm going to do the residual calculation, there could be some subtle differences, but largely they end up pretty close to the same, let's say. But accounting is going to keep goodwill on the balance sheet unless it's impaired, right? Which could be forever. If I do a good M&A deal, keeps going up in value, I never impair that goodwill. What am I doing for tax purposes? Year one, I'm taking 1/15 of that. So I'm amortizing that over 15 years. Book tax differences right off the bat. I might have an impairment in the middle, but then I gotta deal with that because now it's gonna be different because I don't impair goodwill for tax purposes, I amortize it straight line over 15 years. Okay? We have 5.5 showing us that, and that is Jack.
Alrighty, so for this one, it's acquired goodwill and asset acquisitions. So the question is, suppose that on July 1st, 2025, PCC acquired the assets of another business in a taxable acquisition. As part of the transaction, PCC recognized $180,000 of goodwill for both financial accounting and tax purposes. During 2025, PCC amortized $6,000 of the goodwill for tax purposes, which you can see the equation right there, and did not impair any of the goodwill for financial accounting purposes. What was PCC's book tax difference associated with this goodwill in 2025? Is it a favorable or unfavorable difference, and is the difference permanent or temporary? So for the first answer, we get that it's $6,000 favorable, temporary book tax difference. The amount capitalized goodwill is the same for book and tax purposes. And PCC deducted $6,000 of the goodwill for tax purposes and none for book purposes.
Yeah, so when I look at my financial statements, I'm not gonna see amortization expense on there relative to this item. And so column A, my financial statements don't have the number. Column B, I'm gonna insert an amortization expense of $6,000 because that's my book tax difference. And it's gonna land in column C, my taxable income, my tax return. I'm gonna take a $6,000 deduction. That's a favorable because I'm lowering my tax burden, right, relative to book income.
So for the what if, it's assumed that at the end of 2026, PCC recorded a $30,000 goodwill impairment expense on its income statement. What is PCC's book tax difference associated with its goodwill during 2026? Is the difference favorable or unfavorable? And is the difference permanent or temporary? The answer, we get $18,000 unfavorable. It's a temporary book tax difference. And we compute this by, we first take the goodwill, and then initially we look at the impairment as well. And then from there, we use the same calculation that we did in the first part to find the 180 months. And then from there, we utilize the goodwill divided by the number of months times the 12 months to get the 12,000. Then ultimately, we take the 30,000 minus the 12,000 to get our final answer of 18,000.
So hopefully my columns, that's the way it resonates to me. So my first column, financial statements, I look at that and that has a $30,000 deduction for goodwill. So that's when I walk down the hall and I talk to the accountant, like, what is that number there? Oh, we had an impairment of the goodwill. We wrote it down by 30,000. Like, okay, got it. And then I look in I know on the right side, my third column, I have to get to 12,000 because that's my full year amortization of goodwill for tax purposes. So my book tax difference is the delta. 30 starting point, I gotta get to 12, I have an 18,000 unfavorable item because I have more deduction in financial statements than I do for tax, so it's working the wrong way from paying less tax, right? And this is technically temporary in nature, even though purchased goodwill may sit on the balance sheet in a perfect M&A transaction forever because it's never impaired. So you would think like there could be a scenario where it would be permanent, but I think under the accounting literature, it's always thought of as temporary. Okay? I think there's a lot going on in this example, but it kind of shows you how the interaction between book and accounting, book and tax have to work. Okay, let's pick up another topic, stock options. And if you were in individuals, we're going to revisit some topics on the individual side because the recipient of the stock option is going to be the individual. And we're talking about the corporate side here, but you're going to see many of the topics we talked about in that are going to come back to you here. So Generally, stock options. So corporations often compensate executives and other employees with stock options, allowing the recipients of such awards to acquire stock in the corporation at a predetermined exercise price. Sometimes people call that the strike price, but that's the amount that the employee has to pay the corporation to exercise the option. You don't have to, it's an option, so you don't have to exercise it. But if the value of what you acquire is less than the exercise price, that's like it's on sale, and we all like sales, right? So you might exercise at that point in time. If it flips and the value is below your exercise price, you never should buy things that are overpriced, right? This would be clearly overpriced. So you get to do that after a specified period of time, which is known as the vesting period, right? These are carrots that try to keep the employee to behave as an owner of the business, i.e. make the right decisions for the business long-term that drives value accretion for the stock, not necessarily short-term decisions. Okay, so we want key employees to behave as owners, drive permanent value in the business that should be reflected in the stock price. Okay, so the vesting period is kind of like I want you to stay around and behave like an employee for a period of time. So exercisable after a certain period of time. That's the vesting period that you have to wait before you can exercise your option. Stock options are valuable to employees when the stock price appreciates above the exercise price, because once the employee vests and can exercise the option, they purchase stock at a below market bargain price. The bargain element is what we always focus on when you're dealing with stock options. Like, what extra value did you get by exercising this, right? Stock options, a popular form is they align the interests of employees with that of stockholders, right? So the C-suite gets this, it filters down, many companies make a decision, and it comes down to more levels down below, and hopefully you might get to this position in your careers where you produce stock options. This is where people can get very, very wealthy if you're at the right company at the right time. The tax treatment for the issuing corporation, so the company that has issued the options to the employees, depends on whether the stock options constitute what is called incentive stock options, ISOs, or non-qualified stock option, NQOs. That's the first thing you have to look for. Just like we did in the prior topic, is it assets or stock? Is it ISO or NQO? If you start applying the rules without first honing in on what is that issue, you're going to get to the wrong answer. Okay, so incentive stock options. The book treatment for incentive stock options is corporations expense the estimated value of the option as of the grant date. The grant date is the date at which you've been given the stock options. They're not exercisable. There might be a vesting period that you have to wait, and then they become live after the vesting period. Okay? But the grant date is when they are given to you. So financial statements is very early. Grant date there, they have hire somebody, or they have somebody in the organization that estimates the value of those stock options. Accounting, as we know, is very comfortable with making estimates. They do it across the board. Tax is not conducive to taking deductions for estimated expenses, right? We want to see real transactions. So accounting is doing it for, and that's because, again, accounting is doing one thing, tax is doing a different thing. That's why they're right for deductions here, or right for book tax differences. So, and they're doing the as of the grant date, so we have a timing issue, and they're doing it on a straight line basis over the vesting period. So they estimate what this value is. It's a 5-year vesting period. You take 1/5 every year. You're done. For tax purposes, corporations issuing ISOs are generally not allowed a deduction. And this depends on, if you remember back in the individuals, if they hold it over a certain period of time, then they get a benefit. If they have a disqualifying disposition of the option, then it gets triggered, and that causes the corporation to be allowed a deduction. But as a general matter, ISO, the recipient's going to be well advised and wait, because it's going to be a tax advantage to them, individual employee, corporation conversely does not get a tax deduction. So you got deductions going through for book, you have no deduction for tax. Book tax difference, right? So non-qualified options, the book treatment's the same. They just look at the award on the grant date, estimate it, and start doing it in straight line over the vesting period. So you do the same concept for book purposes. Tax treatment here, we have a vastly different result if we're dealing with NQOs versus ISOs. Upon exercise, now we have a dichotomy because book is doing something at grant. We don't do anything until exercise for tax purposes. And not everything gets exercised. I had a friend who went to work for a client and got a bunch of stock options and the stock went down. Stock options weren't worth anything. Never exercised them. But book is still took deductions because they started grant date. And so we have a difference in timing. So nothing happens for tax purposes until exercise. And at that point, we deduct that bargain element. What did the value of what they received upon exercise versus what they paid me the exercise price. That's the bargain element. And what you'll see is the employee has the bargain element as taxable income. The employer has the bargain element as the compensation expense at exercise. So, two things can happen. We got a timing issue. Accounting's doing something at grant. Tax does it at exercise. Accounting's doing it on estimates. We're doing it on actual. Those things aren't going to equal. Right? Okay. 5.6 is Connor. 5.6.
Okay. So assume that on January 1st, 2023, PCC issued $10,000 in 10,000 incentive stock options, an estimated fair value of $6 per option. The options vest at the end of 4 years. For 2025, PCC records $15,000 compensation expense related to the ISOs. What is PCC's 2025 book tax difference associated with the incentive stock options? Would the difference be favorable or unfavorable? Would the difference be permanent or temporary? So in this one, it would be $15,000 unfavorable permanent difference, and that's because PCC does not deduct compensation expense related to ISOs for tax purposes.
Yeah, so you can imagine, again, I like to think of walking down the hall analogy. You're going down to the accounting people, you're just like, hey, I saw the financial statements and we have stock option expense in there or compensation expense tagged to stock options. What was the award? Hey, hopefully they would tell you, well, this is an ISO. Oh, I remember ISOs are non-deductible, right? So I have a 15,000 unfavorable because it's in column A. It's not going to be in column C, so I have to pull it out of book income. It's an expense, so it's unfavorable, so my taxable income is going to go up, and it's permanent because I'm not going to get a deduction for tax purposes on ISO. Okay, perfect. Okay, so when you're thinking through NQOs, which do give a deduction for tax purposes, they can generate both temporary and permanent book tax differences. But during the vesting period, an unfavorable book tax difference is recorded each year equal to the book expense of the options that have not yet been exercised. Right? Nothing happens for tax purposes until exercise. So, accounting starting earlier, they're starting at grant. I got a temporary unfavorable item up until the year of exercise. Okay? It's considered temporary because it will reverse upon exercise. So the literature, it treats it as a temporary difference. So what happens on exercise? On exercise of an NQO, the corporate tax deduction, which is equal to the actual bargain element. Actual is important there. That's going to drive the permanent element of this. Remember, accounting starts earlier on estimates. Estimates are, I had a colleague that always says your estimate's wrong the next day, right? Nothing equals the exact estimate, but accounting's fine with that. Will differ from the cumulative book tax expense, which is estimated as of the grant date. this portion is considered a permanent difference, as book and tax will never equal on this part. That's a function of starting with estimates and having a deduction triggered on actual, right? Because you don't know what the tax deduction is until we have numbers, right? What is the value of the stock versus the exercise price? Accounting's estimating what the value might be over time as of the grant date being set up for that. So you're gonna be partially temporary, partially permanent. And it's gonna be over time on these things. I think example 5.7, the brave soul is Chin Chin. 5.7.
So, assume that the general for 2025, this is going to be the 20,000 this estimated $10 value per option. Each option has a recipient to purchase one share of PCC stock for $10 a share.
So just to make sure you get those numbers. So we all know, accounting and tax knows what the exercise price is because that's in the award. It's $10. Accounting is estimating that it will be worth an additional 10. So the stock will be 20 at exercise. That's how they get to their number. Right? That's the $10 value of the option. Okay.
So the options vested as the day on December 31st, 2026. So the vesting period is 2 years, from 2025 to 2026. Assume no option were exercised during the vesting period for 2025 and 2026. PCC deducts the compensation expense of 100,000 for both periods. What are the PCC's book tax difference associated with the non-qualified option? So the answer is 100,000 unfavorable temporary book tax difference in the both 2025 and 2026. So PCC reports 100,000 of compensation expense for book purpose in 2025 and 2026, and 0 for tax purpose in both years, because no option were exercised in 2025 and 2026.
So just be methodical here. You got the first identifier we're dealing with ISOs or NQOs. This is NQO, so we know we got a potential deduction, but it's nothing happens for tax until exercise. And so accounting did their thing. We go talk to them. We understand what they're doing. We're going to see 100,000 in each of the following 2 years as compensation expense relative to this, but we don't get a tax deduction yet. So those are unfavorable temporary items because I'm taking them out of book income. That's going to raise taxable income by 100,000 each year. Okay.
So question number 2 is assume that the index has above and that on March 1st, 2027, employee exercised all options at the time when the PCC stock was trading at 25 per share. So what is the book tax difference associated with the stock option in 2027? The answer is 200,000 variable temporary book tax difference. So 100,000 variable permanent book tax difference. Because the company claims the 300,000 tax deduction in 2027 equal to the number of share purchase, the 20,000 times the bargain element. The bargain element is equal to the $15 per share. So it equal to the 25 minus the $10.
So let me pause you there. So the employee paid $10 and received something of value for 25, right? Great. Congrats to them. That's the bargain element. That's the amount they take into taxable income. That's the amount the company issuing the NQOs takes as a compensation expense. So actual numbers at exercise, we knew it was exactly $15 bargain element. Accounting thought it was only going to be 10. They don't go back and restate their financial statements. As long as they had a good estimate, they followed the accounting literature of how you estimate that, and they did it, that is what it is. That's the function of living with estimates, right? And so we have a permanent item because we're gonna take a higher deduction, $5 per share, because the 15 that's actual bargain element versus the 10 estimated bargain element, that will never be a deduction for accounting purposes. But we have tax rules that tell us you get the full bargain element as the deduction, right? So that's the permanent component of the 300,000 deduction we're taking in that third year. Okay? Is there anything else in there that?
So the PCC does not deduct any additional compensation expense for book purpose because the vesting period cannot affect the 2026 and the 200,000 of tax deduction is reversal of the total 2025 and 2026 unfavorable temporary book tax difference. The exercise the 100,000 tax deduction is a favorable commitment difference. So in conclusion, the book compensation expense is based on the grant rate fair value during the vesting period. And the tax deduction is based on the bargain element exercise. So this kind of timing mismatch creates the temporary difference. And the exercise tax deduction creates the permanent difference.
Yes, good job. So I would focus on this last paragraph, the $200,000 favorable temporary. That's the reversal of what books did in the first 2 years. When tax is getting caught up, that's why it's temporary. It's favorable because I'm now putting a deduction in the column B that wasn't in column A in my hypothetical. And then the last part of that first line, $100,000 favorable permanent, because that's the difference in actual bargain element versus the estimated bargain element. Now, the reason we're doing temporary and permanent, when you say like, okay, we're imputing tax liabilities, a $300,000 deduction. But when we get to tax accounting, that temporary and permanent is going to be important because it's going to affect our effective tax rate. That's the reason that's vital. Okay, so this summary chart helps quite a bit, I think, here. So it goes down on the first column, incentive stock options, non-qualified stock options in the years before exercise, and in the year of exercise. So those are the rows. You see what book treatment is. In each one of those, they take the estimated fair value of the stock options over the service period, which is the vesting period. Okay, so they're doing the same thing. They'll come down and talk to them like, what? They're going to be like, why are you keep asking me about NQOs or ISOs? I don't care. Well, I care. There's tax differences between the two. Okay. And you see the tax deduction, the third column, no deduction for ISOs, no deduction for NQOs in the years before exercise. I get a deduction at the year of exercise for the bargain element. And you'll see the unfavorable permanent for the first incentive stock options because I don't get a deduction. I get unfavorable temporary because I don't get a deduction yet on NQOs while they're not yet exercised. And then with the last example that we went through, I get a favorable temporary difference, reversing out that book treatment, and I get a favorable permanent difference if the bargain element exceeds the initial estimated value of the stock options. Otherwise, it flips and it's unfavorable permanent. So if that $10 estimate actually was $8, then I had to account for that $2 difference would have been an unfavorable permanent item. Okay, I think this is interesting because I love big numbers. Okay, and this ties into the article we covered earlier, which was talking about why do I see all this big profits on your income statement and I look at your tax return and it shows me zero, right? If I'm a politician. So one of the big drivers listed in that article and explained here is the deduction for non-qualified options. Okay, so this is Meta, which was Facebook. Meta now. This is Mark Zuckerberg. And so Zuckerberg had lots of stock options, but still has lots of stock options out there. But in this particular award, this drove a large deduction for Meta on their corporate tax return, reducing what you would see from a book perspective, much lower down to zero. So, right in the middle there, simultaneously created a tax deduction for Meta and compensation income to Mr. Zuckerberg of approximately $2.3 billion. Can you imagine doing a tax return and somebody comes in and tells you, hey, I got a $2.3 billion number that's going on there? Well, it's going to be on the tax, but $2.3 billion. The company's tax benefit of $800 million also created an $800 million tax bill for Mr. Zuckerberg. I'll show you in a minute, but back at this point in time, we had a 35% corporate tax rate, so that $2.3 billion compensation expense is worth 800 million of tax reduction value because of the 35% tax rate at the corporate level. And at this point in time, the highest individual tax bracket was 35 as well. So, first of all, I would tell Mr. or Mrs. Politician that yes, Meta got a big deduction, but go look at this 1040 that this individual filed, and they paid the same amount of tax. So you as the Treasury, you're looking at the reduction in tax, but there's a big increase in tax over here as well. So that's the first point, is that there's two sides to every coin. From compensation expense, there's compensation income. Okay? And since going public, Meta has reported more than 50 billion of U.S. net income financial statements. Yet the company reports a federal net operating loss carryover as of December 31 of 21 of $10.61 billion. Most of this difference results from book tax differences in stock option compensation. So they are trying to incentivize the leaders of that business, which include Zuckerberg and surely all of his top lieutenants, to behave as an owner. And guess what? The value of the stock goes up. Everybody's making money, and exercising these options creates the behaviors that drive that value, but the value then gets taxed through the options exercised. So in early 22, the Meta stock price declined by more than 40% because nothing goes up straight, forever. Many employee-held stock options went underwater, which means that the exercise price was below the value. Value was below the exercise price. You're not going to overpay for the stock, right? So you just don't exercise it. That means they're underwater. Employees won't be exercising stock options, which means Meta doesn't get a tax deduction from tax deductions premised on exercise. So I went through these numbers. So the fair market value at exercise was $37, almost $38 per share. The exercise price, that was what Zuckerberg paid to Meta, was 6 cents. So would you pay 6 cents for something that's valued at $38? We all would. The bargain element is almost the entire amount, $38 per share, and the number of options exercised was 60 million. That's the $2.2 billion. So when on his tax return is income, when on Meta's tax return is a deduction. So, and roughly is the rate for that. Pardon me. Down here at the bottom on this chart is the total deductible compensation expense for all NQOs for Meta. So all the C-suite and all the other key employees, this is the amount that they were deducting, and that drives that $10 billion NOL. So my point is saying you can change those rules on the how much you allow for a deduction of NQOs. But if that is the law, then they're taking deductions for that on their tax return. Okay? And that can drive an NOL for tax purposes while you're still showing book income in certain years. Okay? So this is directly caught in that corporate alternative minimum tax because they will want to see Meta pay a certain level of tax. They're one of the companies of a size that rule applies to. But if you happen to not be that, this is just the company applying the rules as they are. Right? And you might say, why is this seems like an extravagant bargain element. But remember, this is a publicly traded company. There's a board of directors that are acting on behalf of the shareholders, so they're not just giving out very low exercise price options. These probably stem back from when nobody knew what Facebook was and Meta was. And he grew, in part with his effort, his vision, grew this business to what it is. So that's why you get these outsized awards like this. But there's nothing nefarious going by this, because I think you have to, the assumption being that the board is doing the fiduciary duty on behalf of the shareholders. And I think if you look at the stock price over this, that most shareholders are really happy. Okay? But that just shows you the magnitude of these numbers and how they can drive tax liabilities. Okay. Last topic I'm going to leave you with is capital losses. So capital gains are included in taxable income and taxed at the normal 21% corporate tax rate, right? No preferential treatment for corporations on capital gains. Individuals only, okay? So it doesn't matter if we have it long-term or short-term, we just have one rate of tax. So it doesn't matter how we have capital gains, how long we hold this. The distinction here is capital losses. So capital losses in the corporate world can only be deducted to the extent of capital gains. So if I have a net capital loss in a given year, it's not deductible. Okay? So book treatments, what if I have a capital loss on an asset disposition? It's in book income, right? There's no rule, why wouldn't it be in book? But for tax treatment, there's no current tax deduction for net capital loss, because I can only offset it against capital gains. If I have more losses than gains, it doesn't go anywhere. I can't deduct it on my tax return. Okay? So, although I cannot currently deduct it on that tax return, this is an instance where the government allows me more than 1 year to utilize that capital loss. So the rule is, I still can only use capital losses to the extent of capital gains, but I get to carry that capital loss from the current year back to the prior 3 years and look for capital gains in those years. If I have them, I amend those prior returns, I claim the loss, reduce the capital gains taxation, and I get a refund from the government. If I don't have that profile in the prior 3 years, I carry it forward for 5 years, waiting for capital gains in the following 5 years. So what we always did, if you are carrying forward a capital loss and you're in year 3, 4, or 5, you don't want that to expire, which means it goes beyond the carry back, carry forward year, and you don't get to utilize it, because then what you did is you had a loss economically that never got tax effective. It never landed on a tax return. So what we would do is talk to companies and say, do you have any assets that you are thinking you might exit at a gain? Well, do it this year instead of next year, because I can do it this year and utilize that capital loss against it. If I wait until year 6, then I just have capital gain income. So there's planning, and the government understands that. They give you 8 years to utilize this capital loss. But that's the distinction. And remember, you start talking about carry back and carry forward with an accountant, they'll look at you like you got 2 heads, right? It's a financial statement year. We don't carry things over and carry things back. But tax rules are different. And so we have differences when we do that with capital losses. And we do that same thing with net operating losses. Okay, so that will be where we'll pick up on Monday. We do have the midterm next week from today. It will be every day through Monday. So we will and let me know if you're preparing for the exam. We have 1 page of notes, front and back. I asked you to handwrite it. I'd like you to have your spend some time thinking about this and learning. It's not just training for exams.
What's the format for the exam going to be like?
2/3 multiple choice, 1/3 short answer. Focus on the examples we've been going through. That's the application of the rules and options. You can work through these examples.
明年的考试，他连个考试，连个模拟有没有？就这是
We got a review exam.
写的没什么。
We got like separate exam stuff for.
他肯定出的会比 PPT 要难，他一定出的比我更难。
I don't have any review exams. Sorry. The review exams are on the slide. Those examples are the same thing. Excellent.